Hi, everyone. This is Jason Bjark of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. He's been writing a paid macro newsletter since 2014, the Forest for the Trees newsletter. Luke Gromen, thank you for joining me again.
Thanks for having me back on, Jason. It's great to be here.
And we're recording this interview on Monday, June 17th, 2024. The 10-year US Treasury yield is at 4.279%. It's been a roller coaster the last 6 to 9 months. The gold price in US dollars is down a little bit. It's correcting. It's at $2,319 when we're recording this interview. Luke, I want to get your thoughts on what's going on in the US Treasury market right now. Do you think that a paradigm shift, a permanent one, is occurring by non-G7 central banks away from US Treasuries after the Russia sanctions in 2022?
Yeah, I do. I ultimately think we will look back and see the Russian Treasury sanctions, I think, will come to be seen as equivalent or a moment in history like the Nixon shock in 71, where basically Treasury bonds were declared to be no longer risk-free if you disagree with the policies of the U.S. government vis-a-vis certain geopolitical events.
And on our first call here, which dropped, we had some audio problems, so we're going to restart it because you said some really interesting things. You said that, in your opinion, DC is split now over what's happening in the US Treasury market. I think, based on what I'm hearing with the amount of the budget deficits, DC spending from the White House the last couple of years, also Congress, and how like both political parties just want to keep spending and spending and spending, it seems that a major supply and demand issue is developing in treasuries. But you said that part of the crowd here, like the policymakers or think tank people that advise the policymakers in DC, you said they don't want foreigners owning US Treasuries now?
It's not that they don't want them owning them. I think there's Washington, D.C. is split into, on this topic, at least two groups. One group that wants the status quo of the last 40 plus years, where it's basically Wall Street and financialized centric. Basically, Washington continues to subjugate the U.S. working and middle class to support the Treasury market. In other words, whatever's good for the bond market is good for America, even if it's bad for America, or the bottom 90% of America. There is a growing other side of Washington, D.C. that understands that if it wants to compete against China and in the world, the Treasury market has to be significantly devalued on a real basis. In other words, the U.S. needs to get back to making something other than debt, and that side understood, at least part of that side understood what the long-term implications of sanctioning Russian FX reserves, which would be to discredit on some level FX reserves broadly and U.S. Treasuries as primary global reserve on some level. And it tends to break down as kind of the status quo Washington, Wall Street centric led Washington in the former group, and part of the defense and intelligence establishment in the latter group.
Okay, so the way that you see things, it's not split along party lines necessarily, it's split along other types of ideological lines.
Yeah, there's a view. It's an interesting group. Right now, it's become consensus that something needs to be done about China. The former group that wants to do something about China while not changing anything regarding the financialized U.S., which was part and parcel. The part and parcel of that was we buy stuff from China. We send China dollars. China buys treasuries. And so basically China sends off stuff and we send China treasuries. If we want that arrangement to stop, we need to do something other than have China make stuff for us. Basically, Chairman of the Joint Chiefs of Staff, Admiral Michael Mullen, said it best in terms of the views of the last group, or the latter group, I should say, in 2011, when he said, we're borrowing money from China to build weapons to face down China. And increasingly, as the CEO of Raytheon said last year in the FT, using Chinese components. So the latter group realizes that it's a fool's errand to try to compete with China while you're borrowing money from China to build weapons to face down China, encircle China, and using Chinese components. And there's been some movement to try to go to Mexico or Vietnam And the reality is, if you look at the trade flows, what's happening is basically it's going from China to Vietnam or Mexico and then to the U.S. Not a lot has really changed. So that's there is, I think, I won't say it's a fully consensus in Washington, but from where I sit in the cheap seats, it seems like Washington is largely in agreement that the relationship with China needs to change. The former group is still in pretend land that they think they can keep the Treasury market as is and change the relationship with China. The latter group, again, centered by people who have to be realists for a living, like people in the military and in the intelligence world, realize that you can't change the relationship with China without changing the structure of the Treasury market, and in particular, specifically, without ending the Treasury bond as the primary global reserve asset in favor of something like gold or something like Bitcoin.
Do you also see a major supply and demand issue developing in the US Treasury market? Because if DC is going to keep spending at this pace, whether it's Congress or whoever is in the White House in the next term, they don't really seem interested in actually cutting spending. Spending's increasing. On top of this, you have higher interest payments on the debt, and you have approximately 10 trillion of debt that needs to be refinanced in the next 10 to 12 months, something like that, or 12 to 18 months, excuse me. So do you see a major supply and demand issue developing in the U.S. Treasury market, especially if China and Japan are going to be net sellers of treasuries?
It depends on the level of the dollar. If the dollar stays at 105 or goes higher, yeah, there's going to be a Treasury issue, Treasury supply demand imbalance, almost assuredly. If the dollar keeps going down, we've gone from 114 in September 2022 to 105 today. If the dollar goes, under 100 over the next 6 to 9 months, then it might be okay. The trade-off there is inflation will pick back up. I think the stock market will do well. But really, you tell me where the dollar is, and I'll tell you if we're going to have a Treasury market supply problem or not. Above 105 from here, yeah, we're going to have a Treasury market supply problem. Below, I don't know, below 104, 103, and then continuing down from there, it'd probably be okay.
So you don't think that the other the other G7 central banks that are talking about cutting rates, you don't think that they're going to go in there and start buying maybe U.S. Treasuries to help support the Treasury market?
Uh, I look around the world and I'm not sure who's running surpluses against us big enough to really matter. The Russians obviously aren't going to be buying. Chinese aren't buying. The Japanese, again, depending on level of the dollar, which again makes it tricky. I think they could buy some more, but the challenge with the Japanese is the weaker the yen gets, the more attractive they get in terms of sending us stuff as opposed to China. But it also means that their energy bill gets more expensive because their energy bill, as far as I can tell, is still priced in dollars. So if they're going to weaken the yen and keep weakening the yen to send us more stuff and bump China out of the mix on the margin, they're going to need to save more of their money to buy energy. And so then I go to Europe. Europe doesn't look like they've got any room to buy a lot. South Korea can maybe buy a little. I don't know. I don't know who the buyers are at the central bank level, even if they wanted to.
And that sounds like why the U.S. Treasury then would announce that they're going to restart this U.S. Treasury buyback program that they haven't done since the 1990s. Because I heard someone else do a video on this buyback program, and they compared the analogy of it to using the credit card to pay off the mortgage. Do you see things similarly?
I think I have a little bit more nuanced view of it, where I think as we look at it, I think if we're sitting here a year or two from now and we look at what the Treasury buyback program has done, I'd be willing to bet a decent chunk of money that when we look at it, the theme from the Treasury buyback program will, over that course of time, fall along the lines of what you just described, right? Which is issue short, issue more, basically shift issuance to the front end. So issue more at the short end to buy back and smooth over and shape the curve, any parts along the curve where there's not enough demand at the long end on the margin. I don't think it's a huge deal per se yet. We'll see how it develops, but I do think that's directionally sort of how it will be used. Is borrowing short, but basically refinancing, shifting issuance to the front end on net.
Are you surprised that it looks like a lot of institutional investors and foreign capital from outside the US is still coming into like the Mag 7 and the S&P 500 despite some of the issues in the treasury market and how a lot of people disagree with US foreign policy?
No, it's exactly what I would be doing if I was them. They're still getting dollars. I don't want to buy treasuries because the U.S. government can't afford to pay me a positive real rate with debt to GDP this high. And so if that's the case, I want to own anything but treasuries. I'll own at the short end. I'll own bills. They're happy to pay me 5% the short end. Great. I'll take that and roll it. Uh, but beyond that, I'd much rather own Microsoft or Apple or, you know, Eaton or, Industrial Parker Hannafin or Caterpillar than a treasury bond. Um, and I'd much rather own, and none of those are stock specific security recommendations, by the way. I don't cover any of those, so I'm just picking sort of blue chip names out of the air. But I think what we're watching in terms of the charts, right? If you look at S&P 500 divided by the long bond TLT ETF stocks, the charts hockey sticking. Nasdaq over TLT. Now, there was a period of time a couple of years ago, the Nasdaq and the long bond traded in inverse with each other, right? When rates went down, the Nasdaq went up, and vice versa. Well, now rates are going up and Nasdaq's going up. That correlation in the last year or so has broken, and the Nasdaq over TLT chart is hockey sticking. That makes perfect sense to me. I would get out of long bonds and into something that better preserves and protects purchasing power, which are equities. Gold over TLT is also hockey sticking. But it's exactly what I would do if I was in their shoes, because the reality is that the global bond market is $130 trillion. Treasury markets, call it 27 or 28 trillion of that. The global gold market's only 14 trillion. The global Bitcoin market's $1.4 trillion. The U.S. equity market's 65 trillion. So give or take. So you sell what you can, and if you want to buy something that better hedges the reality that the United States government must have negative real interest rates over time, then the first thing you're going to is into equities. And so to me, it's just a flow issue.
Yeah, I agree. I think there's a lot of flight capital. There's also been a ton of accumulated monetary inflation, fiat currency creation, not just by the US, but all these governments and central banks the last 5 years. And I think the US capital markets, specifically the US stock market, large cap tech companies, gold, Bitcoin, they've been huge beneficiaries of this. I saw a statistic that I think the Mag 7, their market cap, is now larger than the stock market of pretty much every other country on the planet now.
Yeah, and it's I believe it. It leads to this interesting dichotomy. We want to separate from China, but we keep letting China buy more and more of our stock market. We want to you can't have an independent foreign policy when your adversaries are buying up your stocks, but you can't have the dollar be the global reserve currency if you don't let your adversaries buy your stocks. You see the problem?
Is this
So
Triffin's dilemma, or is this a little bit different?
it's a little different, right? Because ultimately the flow point we made earlier is a manifestation of Triffin's dilemma, right? The U.S. debt position is such that the U.S. needs negative real rates. Foreigners are recognizing that, and so they're moving into assets that basically will do well as the U.S. Governments don't go bankrupt. What they do is they inflate, and so as the U.S. inflates, because of the debt position to finance the debt position, they're moving into stocks. That's a manifestation of Triffin's dilemma. This is everyone wants to call the new China thing Cold War 2.0, but a quorum of the U.S. defense industrial base was not sitting in the Soviet Union. And the Soviet Union did not own, I don't know, $5, $6, $7 worth of U.S. stocks and growing. I mean, we're still running $300 billion a year deficits on a trade basis against the Chinese. So it America needs to decide what it wants to be when it grows up. Does it want to be dependent on China, or does it want to have an open capital account? Because it can't do both.
And I think you also brought up another interesting point that there's now a fight, it looks like, going on for key natural resources. The Department of Defense over the last 12 months has been adding new metals to the stockpile list, including copper. And then in the last 3 to 6 months, you've had both China and India. They've accumulated more copper way above trend than they have, I think, for pretty much all of 2023. And India imported just an insane amount of silver too.
Yeah, I've seen a little bit of the data on copper, and it makes sense. And here too, it's this is a sign of monetary breakdown, right? In terms of, why would you need to hold copper, whether you're China, whether you're India, whether you're the United States Defense Department, when you could just hold treasury bonds, when you can just hold dollars? And the answer is that what we're watching is a breakdown of the relationship where treasuries were as good as gold for copper, or as good as gold for silver, as good as gold for these materials. You're starting to see people say, "You take the paper, I'll take the actual stuff. Thank you very much."
Well, and the copper won't go to zero. It may rust a little bit, but you can clean it off, and eventually there will be a usage for it. I mean, we're talking, I don't know if you've been researching this with the next generation data centers for artificial intelligence. Once they start building these things out and then it start with construction the next couple of years, they're going to require an order of magnitude more power electricity generation.
Oh, yeah, it's. I have a personally a big investment in a private equity firm that does electrical infrastructure equipment, and the management team of this private company was at a trade show recently, and the amount of applied for generation in the United States is, I want to say, it's almost double what we have in place right now over the next 10 years. And what we have in place right now has been built over the last like century. So I don't think people, and that's does not, I don't think there's a lot of assumption there for, I mean, I'm sure there's AI stuff built into it, but in terms of uh, some of the potential exponential growth in that, I'm not sure anyone can fully anticipate what that could possibly be. So the demand is absolutely there, and it's why not, if you've got the storage for it, and you know that the United States government cannot afford long rates much over 5%. What that says is the United States government cannot keep treasury bonds money good relative to copper, relative to silver, relative to these critical metals over time. So why not just stockpile the metals instead?
Yeah, also like the $3 pound copper. I mean, in this environment where we've had tons of monetary inflation, currency debasement for especially the last 5 years, with all these governments monetizing debt and doing stimmy checks and QE programs, the environment where copper projects are economic at $2 or $3 a pound, it's not going to exist going forward.
Yeah, the peak cheap copper is definitely a real thing from what I can read and tell. There's analysts that would know that in a lot more detail than I would, but I have no reason to believe multiples of them are you can see the data in terms of the ore grades, et cetera. It seems like copper is going to need to keep getting more expensive to keep supplies growing.
You also have to use way more energy, diesel, electricity, so all these things. And now I think the average copper deposit now is below 1%. So that's like 20 pounds of copper for every 2,000 pounds of uneconomic rock that has to be like hauled and crushed and separated with chemicals and electricity. So, I mean, like it's an enormous task just to get 1% copper grade. Very, very expensive. It's $1 billion to build a medium-sized copper mine, over $1 billion.
Yeah, it's incredible. To me, it's not to I find the valuation gap between AI and the raw materials you need to build AI fascinating. It's not to say I would necessarily short AI in terms of some of these stocks, but just it doesn't make a lot of sense to me uh, that their prices are what they are, and the people they need to keep their lights on, how far much far below them they trade. That doesn't make sense to me in the long run.
Oh yeah, I agree. Same thing with the valuation for these oil companies, because the oil companies in the S&P 500, I think they earn about 15% of the total profits each year, and I think they only have about 4% of the market cap.
Yeah, you would think that wouldn't sustain over time.
Well, I mean, in the environment here where a lot of institutional investors are not allowed to buy fossil fuel companies, so coal, natural gas, oil companies, for a while, I think they weren't even able to buy nuclear power, uranium too. So, I mean, there's like with the bylaws of some of these pension funds and institutional investors, they're so pro ESG, they can't buy normal energy companies.
Yeah, I suspect that probably does play into it.
Well, it will have to change because, as you said there, we need to make the investments into the infrastructure first for energy and copper and the other raw materials. You have to build the data centers before you can have all these advanced AI in the future.
No, that's right.
So I want to ask you about gold and silver demand in China, India, Japan, Korea, Asia. It looks like that's where the demand spike is. Are you surprised that the demand has spiked there first compared to, say, the US, where there's been all these QE programs?
No, I'm not surprised there. I think when you look back, the Chinese government's actually been encouraging their citizens to buy gold since either '02 or '04, maybe '06, and I think culturally, there's a lot longer history to gold as a wealth asset than there is here. Um, and yeah, I'm not all that surprised that it's driving it. They've really been the driver of physical demand for over 10 years. Perhaps the more interesting thing is that they have been the physical demand driver for over 10 years, but now all of a sudden in the last two, their physical demand is starting to drive price. You're seeing a breakdown in the historical relationship where historically increasing gold flows in London and New York drove prices up, and decreasing flows or flows out of London and New York drove gold prices down. And those flows have reversed in the last 12 to 24 months, which is gold leaving London and New York is occurring with prices rising. Um, in the old days, they used to call that a run. um, and so I've been watching what I think is a slow motion run on gold out of London and New York to the east broadly with a pretty high degree of interest because it makes perfect sense in light of what to me seems very clearly to be happening, which is uh, gold is the gold is the BRICS currency. Gold is the new primary reserve asset, de facto being driven by what's going on in the East.
Do you think the bullion banks, like the custodians at GLD or SLV, are they taking advantage of this like spread here between like the Shanghai Gold Exchange, the physical price, or online bullion dealers in mainland China? Where I think like in October, November, starting back then, it was over $200 an ounce differential for gold, and it was over $3 an ounce. I think at one point it was $6 an ounce differential for silver. I think it's down to about $3 an ounce differential.
I suspect they probably are. It is ultimately very interesting to me because it suggests that effectively it was always China can use gold. It looked like the setup they were setting up that they could use gold to defend the yuan. I think October of last year was the first time they actually did it.
Do you think that China will devalue the yuan though?
No,
So you don't think they need to, despite like their banking problems and the real estate bubble?
no. Why would they need to? They're running a big current account surplus. Um, they've got a real estate issue. Uh, it's interesting. We're what 3 years into the real estate issue. By this time, America's banking system was a smoking crater. Um, I think to me, I think they're going to just kind of continue to sort of extend and pretend. Um, but as a current account surplus nation that can print its own currency for commodities, um, I think they will continue. I mean, look, the reality too is the yuan has devalued 50% in the last 9 months against gold, the last 12 months. So maybe it's 40%, but I think the yuan is devaluing against gold. I don't think it's going to devalue against the dollar though. Um, I think that's the last thing they'd want to do. I think they'll just kind of continue to do what they're doing, which is, you know, devaluing steadily against gold.
And with their trade surpluses and their reserves, you think that they're going to be accumulating commodities, whatever commodity they think is cheap. So if they think copper is cheap over the next couple months, they'll buy copper. If they think that oil is cheap, they'll buy oil. Or so they're going to rotate which commodities rather than accumulating any more treasuries.
Yeah, I don't think they're going to buy any more treasuries, not in any real way. No, because I don't think it's still I still think it's poorly understood what yuan oil, what the big deal was about that. People expect a lot of people have expected that to they've poo-pooed that whole thing because they didn't understand what it meant. Um, they're looking for when is China going to be over 50, 60, 70% of their oil imports in yuan, their commodity imports in yuan. That's not what it's about. Ultimately, the reason why it's so important is that in commodities, the marginal ton price is the whole. And so once they can price commodities in yuan, it gives them a great degree of flexibility to manage their currency. It gives them another lever to manage their currency without slowing the economy and without burning down reserves, right? So historically, any country that's not America, they need to buy, they need to buy commodities in dollars. They run a surplus against the Americans. As a result, they need to artificially keep their currency low so they can keep running a surplus against the Americans. So they can keep having dollar inflows in, and they buy treasuries to help keep that currency artificially low. That was the deal. Once China could buy oil and other commodities in yuan, suddenly, you know, the traditional levers of China, which when they couldn't buy commodities in yuan, were, we're running low on yuan or dollar reserves. We need to either slow our economy, or we need to devalue the yuan, or we need to run our reserves down faster to basically support the currency. Those were their choices. Now, because they can buy more commodities in yuan, they can buy commodities in yuan. Uh, they can print yuan and buy commodities for them. And then, in theory, if they want to do that, they can turn around and refine them, sell them back off into the region for dollars, and have dollar inflows that way. Where you would start to see it show up is in the gold to oil ratio, in terms of China's new flexibility, which makes sense because what's giving China the ability to print yuan for oil and other commodities is really two things. Number one, what am I going to do with the yuan? Well, what you're going to do with the yuan is buy Chinese goods. And number two is if you have any yuan left over, you're going to buy gold at a variety of places around the world. And so as a result, the release valve on this should be gold rising against commodities. And gold is up about 4x versus oil since 2008. It's up about 4.2x against the Goldman commodity basket since 2008. So you can see this gold for oil, gold for commodities through local currencies gaining traction by that as being the release valve. And then over time, that means gold reserves in all these countries rise. It also means that all that gold that the Chinese government's been encouraging their citizens to buy for the last 20 years goes up in value. It's a very virtuous cycle of trade that they tick off, because as the gold goes up in China, household wealth goes up in China, energy consumption goes up in China, they buy more, they can print yuan for them, gold goes up more, so on, wash, rinse, repeat. So I don't think they're going to devalue the yuan. I think they have this yuan. I think it's still very poorly understood how yuan commodities means they don't need to devalue unless they make a political decision to, in the same way that the United States doesn't need to default on its treasuries unless it makes a political decision to. And it's not in China's interest to devalue the yuan at this point.
Okay, so you said that they'll just do extend and pretend with accounting, similar to what the U.S. did with the FESB and the Treasury and the Fed did with our banking system in 2008, 2009, changing the accounting rules. And it looks like they're back to similar games, extend and pretend games with our regional banks here in the U.S. with commercial real estate too.
Well, and China has an additional advantage, right? Which again is, if a state-owned bank makes a loan to a state-owned developer and the state-owned developer defaults on the loan and it's not an open capital account, is there a loss? It's the same balance sheet.
Well, except those developers sold pre-sales, right? So like there was a lot of Chinese people that put 20% down payment on a home and it's not even under construction yet. So, and the home
Sure.
prices are down. enormously.
Sure. No. Yeah. I understand that, and it's one of those where, okay, so if the developer's out of business now, the state owns the condos free and clear, and so it's a very different political system, in terms of how it's, in terms of how to think about it.
Okay, so they're not going to allow the traditional bankruptcies and free markets. Not that the US is allowing that to a large extent. It seems like a lot of the rules just kept changing so much since 2002 with the quantitative easing, Fed balance sheet expansion, suspending mark to market accounting for the banks, all those things.
Well, and yes, and they're letting it reflect in the price of gold. Like I said, the yuan's falling against gold, and that's driving Chinese people to buy more gold, and that's cleaning out London, that's cleaning out New York. Wash, rinse, repeat. You know, the West wants China to let these to wants China to open its capital account to let economic reality reflect, and China's saying, okay, we're letting it reflect in gold. Yuan's down 40%, 50% versus gold over the last, whatever, 9 to 12 months. And oh, by the way, the Chinese capital account is open on a limited basis through gold. The West doesn't like that a whole lot.
The gold market definitely looks a lot different in the last 6 to 12 months compared to the past. It looks like physical demand out of China, India, Japan, Korea, Asia is overwhelming all the paper price games. And even like during this move in gold in US dollars, I mean, there was GLD outflows for almost the entire time.
And I think that ties back to the point where I don't think consensus appreciates the importance of the yuan oil contract. When commodities are only priced in dollars, when gold goes up in yuan terms, that means the yuan is falling against the dollar. And that means that the yuan buys less commodities, which accelerates the outflow of dollar reserves and ultimately pushes China towards the balance of payments crisis that Kyle Bass and others have long talked about. What yuan commodity pricing does is now, when the price of gold goes up in China, gold buys more oil in China. It buys more copper in China than it does in the West. And capital flows to where it's treated best. So if gold buys more oil in China than it does in London, it sets up a very easy arbitrage, which is short treasury or short oil futures at, let's put some math around it. Let's say the gold to oil ratio, how many barrels of oil does an ounce of gold buy in China is 30 barrels an ounce, and let's say it's 25 barrels an ounce in London. You short oil futures in London, you take your cash, you buy gold, you take physical delivery, you empty the vault, you move it to China, you get 30 barrels for your 1 ounce there. You cover your short, you take 25 of those 30 barrels and you cover your short over in London, and then you have 5 barrels free. And then you do it again, and you do it again, and you do it again until either the gold to oil ratio rises in London to 30, or if the paper games want to continue to be played, London will run out of gold at some point, and then they'll declare force majeure, and then the Chinese will set the price wherever they want it. So that, to me, is a dynamic that I think remains very poorly understood, that yuan commodities means that China has increasing control over gold prices. That's what we're watching happen.
And I think outside the G7, we're also seeing gold replace US Treasuries as a reserve asset. And then what the games that the Fed is playing with the interest rates, and a lot of people are starting to wake up that the real inflation rate's much higher than the consumer price index is claiming. I think we could be looking at a very long-term global bond bear market, at least in US Treasuries, but maybe in a lot of different countries too.
In real terms, I think in real terms, I very strongly agree. I think ultimately we are watching a soft form of yield curve control already, and I think that the soft form will get harder over time. So I think, depending on events. So, do I think the 10-year Treasury at 4.27% today is going to 8? No. Do I think it's going to 6? Maybe. Uh, I don't think it's going much more. I think the high on it is probably somewhere between 5 and 6%. I don't, no matter what. And the release valve will be Fed balance sheet, international dollar value, and gold prices.
Yeah, I mean, for our listeners out there, a lot of private sector discounted cash flow analysis is priced off the 10-year US Treasury yield because when you do discounted cash flow analysis for an investment or a project, you're doing discounted cash flows off the 10-year US Treasury yield. So, I mean, like whatever the quote unquote risk free rate is. So, at 5%, I mean, that's going to, for the rest of the global economy, that makes a lot of growth and investment, especially for small caps, because we've seen this huge divergence between the major stock market, the large caps, and the small caps.
Yeah, I think part of that divergence is flow driven, right? Where it just is I want out of long term bonds. Where can I go?
Well, you also have like a lot of Main Street businesses, small businesses that are private or not listed on exchange. I mean, they have to deal with variable interest rate debt like credit card debt or revolving credit facility. So every time the Fed maintains interest rates higher, it's priced off the 10-year, like you said. So then like they're dealing with high variable rate debt, plus they have stagflation and shrinkflation if you're a small business owner. And then your customer might not have purchasing power anymore or savings or discretionary income.
Yeah, I don't disagree. I mean, I think those catering to baby boomers probably fine. Um, those catering to uh, consumers that are maybe living more hand to mouth. And I say, obviously all boomers are different, but as a generation, they have $76 trillion in assets and a finite time to spend it. So I think amongst boomers, there's a big YOLO trade. You only live once trade going on in terms of spending. But I think for younger generations that are living more hand to mouth, those of younger generations that are living more hand to mouth, yeah, I think I think things have certainly gotten have likely gotten tighter.
Do you think that something big has to break, like in credit markets or a crash in asset prices, say like regional banks, a lot of them start to fail before the Fed decides to start cutting rates?
No, no, I think they're going to cut. I think ultimately the Fed will do what they have to do to square the circle with the fiscal budget. And you look at where we are. Uh, the U.S. needs higher receipts and a lower dollar. Uh, we're starting Cold War 2.0 with interest expense above defense budget. The U.S. interest debt service was never more than the defense budget at all, ever in Cold War One. And so I think ultimately the Fed's going to have to play their role,
So by
which is
receipts, do you mean like
yeah,
tax receipts, so like income tax, capital gains taxes, property taxes?
yeah. I focus on federal receipts, but exactly.
Yeah, so if home prices start to fall or the stock market stays low for 6 months, I think it would be a funding issue. Then I think the Fed, what they had in 2020, they were started buying corporate debt and municipal bonds too. They had to have the laws changed.
Yeah, I don't even think it would be 6 months. I mean, you look at the May numbers. April receipts were good, of course, was tax receipt. But if you look at the May numbers, um, what we follow is true interest. I call it true interest expense. It's entitlements plus health and human services. So Medicare, Medicaid. Or sorry, it's entitlements, which is health and human services plus Social Security plus gross interest expense. And in May, even with receipts as good as they are, uh, true interest expense was still well over 100% of receipts, with the stock market at all time highs. The stock market went down 20% and stayed there. That number would blow out. You'd be upside down. The dollar would start rising. Dollar starts rising, and foreigners are going to start selling treasuries aggressively to defend their currencies. And you'll see the problem, I think, will manifest very quickly and first in the treasury market. And the Fed has already said repeatedly their number one mandate is treasury market functioning since 2020. It trumps inflation, it trumps employment, trumps it all. So
Do you think in 2025 we're looking at around 1.5 trillion per year in interest payments on the rapidly growing national debt? Plus, you have all the debt that needs to be refinanced at a higher rate.
yeah, I mean, a 5% or 35 trillion in debt, gross 5%, right? I think we came into the year at 3.1% average weighted average rate. It's probably up to 3.4% or so now. So, on a gross basis, you're probably already at, yeah, probably well over a trillion, almost a trillion two. So I don't think $1.5 trillion is crazy, and I think it kind of goes back to why the Fed's going to have to cut rates. Is they're going to need to weaken the dollar and try to help Treasury term out this debt.
And is that fiscal dominance, like you said? So that's where, like, is fiscal dominance what Alan Greenspan and some of the other Fed chairmen have been warning Congress about, that they have to be more efficient with fiscal spending, or is it something different?
I look at fiscal dominance as basically, to simplify, it's where the U.S. government cannot cover uh, interest and entitlement payments out of receipts without printing money. That's how I look at it. It's my true interest expense. When true interest expense is more than 100% of receipts, the U.S. government's in fiscal dominance. And when, which is to say, it doesn't matter what the Fed's doing. We increase. It's a matter of degrees. The higher the dollar goes, the more fiscal dominance the U.S. is in. The lower it is, the more flexibility the Fed still has. The lower the dollar is, up to a point, the more flexibility the Fed still has. But that's how I think about it. And depending on the dollar level, yeah, they are very much in fiscal dominance at a high enough dollar.
So fiscal dominance is a lot different than financial repression, or is it similar?
No, it's different. Financial repression is about basically uh, forcing, regulating, cajoling creditors into buying government bonds at below inflation rates. I mean, you need financial repression to manage fiscal dominance. I would say they're related, but fiscal dominance is really where what is going on with the fiscal authorities is overwhelming whatever the monetary authority is doing.
That's interesting. So you see the U.S. just the Federal Reserve Bank starting to cut rates, and solely because of interest payments on the national debt, the fiscal dominance problem, as you described, and a lot of it's what, solely because of spending out of Congress.
Yeah, I mean, ultimately, uh, we've done a lot of ill-advised things with a lot of borrowed money over the last 20 years, 30 years, 40 years, 50 years. Um, but particularly the last 20 years. I mean, we were running a surplus in 2000 into 2001. So uh, the last 20 to 25 years have been a disaster from a fiscal standpoint. And in the short run, debt and deficits don't matter. In the long run, they do. And particularly when you get over 120, 130% debt to GDP, there's a great article or a great Hirschman Capital in their annual letter in 2020 said, going back to 1800, 51 of 52 nations that hit 130% debt to GDP defaulted on their debt. Usually, and he had a very broad definition of default, nominal default, which was a tiny percent. Most of it was via a sustained period of high inflation, negative real rates, financial repression, etc. So U.S. hit 130% summer of 2020. And that was 51 of 52 countries since 1800. That's 98%. In our business, 98% shots don't come around much. And the one that didn't was Japan. And people say, oh, we'll see. Well, Japan's not going so well now either. We're starting to see some pretty profound yen weakness over the last 2 years. So, um, we'll see. But to me, it's really just a function of we ran up that to GDP, doing some things that the payback was terrible on. If we'd have ran up debt to GDP on things that earned, that paid back well, if we'd have done it on, the modern equivalent of the Eisenhower highway system, for example, it wouldn't have driven debt to GDP up. But, when you borrow $8 trillion going into the Middle East to secure Iraq's oil for China, it's not a good use of funds.
Well, I also see that the jobs numbers, the consumer price index, the GDP, they're increasingly adjusted more by PhD economists. And I would argue, I mean, we even had the Federal Reserve Bank chairman calling out that was a Freudian slip. I said the Obama administration, the Biden administration, excuse me, for how fake the jobs reports are. Jerome Powell's calling them out in public about that. So, I mean, the economic data that we're getting out from DC, from the federal government, it just seems increasingly fake, and it doesn't reflect reality, in my opinion.
No, and I think that's pretty much par for the course for any government. It's just, in theory, if you're the global reserve currency issuer and the global primary reserve asset issuer, you should be held to a higher standard than everybody else. And I think there's a lot of what we're seeing is the devolution of the U.S. toward more of uh, emerging market with U.S. characteristics type behavior, politically, fiscally, etc. And in the short run, that doesn't matter, but ultimately, people start to notice that, and they start doing the things they're doing, which is I don't want to hold the bonds of this country. I'll hold this country's equity. I'll hold more of their equity. I'll hold gold. I'll hold buy commodities with their money, but I'm not going to hold their bonds, and certainly not their long term bonds. And that's happening.
Yeah, I agree. When you see like one political party go after another with like felony charges and criminal charges, and whoever's in power starts issuing charges, I mean, that's typical emerging market banana republic behavior, where one party just immediately starts arresting or kidnapping the other party. It's you've heard stories about this in Confessions of an Economic Hitman and throughout the emerging markets for many, many decades.
Yeah, I'm reading The Storm Before the Storm right now by I think it's Michael Duncan about the late Republic era Rome, and you can see once there were sort of all of these mos maiorum, I think they called it, right? That basically there were always sort of these traditions that you didn't break, and then but they were not written down anywhere. And then once you start breaking one, it's Pandora's box. It's never reclosed. And you break one, then you break a little worse one, then you break a little worse one, then you've never taken one of these people out of office, no matter what they did. Then you take them out of office, and then so it's. I don't think Americans have understood the Pandora's box that's been opened on that front. But again, tying it back, I think markets are whispering, I'm not holding their long-term bonds. I'll own their equities, but I won't own their long-term bonds.
Do you think we're seeing intentional fiat currency destruction by the US, Japan, Europe? Are we seeing like enormous amount of accumulated monetary inflation now intentionally? These governments and central banks devaluing the currency, monetizing debt, buying their government bonds, and intentional currency debasement now going forward?
Um, I don't know about. I mean, ultimately, the most inflationary thing there is over time is a government that is faced with the decision to shrink itself or print the money, because they almost always choose print the money. And there's a lot, I think across the West in particular, uh, there's a lot of that decision coming due or already happening. Um, and the problem with a sovereign debt backed currency system, as we have, and in the West, a sovereign debt backed banking system, is that if you choose shrink the government, you touch off a sovereign debt crisis just mathematically. And that then impairs the collateral of your entire economic system, because you've chosen to use your risk free, quote unquote, treasury sovereign bonds as collateral. So what I bring that up by way of saying that there are very few instances in history of a country being faced with a choice of shrink itself, shrink its government, or print the money, choosing shrink itself. They almost always choose print the money. But in our system, with a sovereign debt-backed currency and global monetary system, it isn't even a choice. You'll crash the system. You'll crash the monetary system if you don't choose print the money. So they can pretend, they can let people twist in the wind for a little bit, but in the end, there's only one choice.
Yeah, it looks like the G7 is going to intentionally let inflation run hot. I mean, there were rumors for the last month that a lot of the G7 central banks were talking about rate cuts, whether that was the Bank of Canada, which did one, the European Central Bank, which did the first rate cut since 2019. There's been rumors for, I think, over a month that the Bank of England will also follow suit. Looks like these central banks and the governments have decided they can't afford higher rates, that they're going to start cutting rates and let inflation run hot and try to, I guess, inflate the debt away in real terms.
They have to. Ultimately, I mean, the only way out of this all along has been negative real rates very negative real rates for a sustained period of time, and they missed their window in 2021 and 2022. In my opinion, they should have kept letting it run hot, and then maybe we'd be on the other side of it by now. But by pretending to be tough guys in 22 and into 23, they've really painted themselves into a corner.
Well, I mean, the Fed and Treasury, they could have termed out the debt then, right? When the Fed had the debt at lower rates, we saw a lot of corporations do that. So you saw like Apple Computer and other large corporations, they went and they refinanced their debt at much lower rates when the Fed cut rates back to zero in 2020 and for 2021. So you saw corporate America, the large cap companies do that, but you didn't see the US federal government do that.
No, you didn't, and I think there's a reason for that, which is they couldn't. I don't think the market was deep and liquid enough for them to do that at those durations.
So for asset allocation strategies here, do you think that deflation will be allowed for a long period of time, or do you think it's smarter to focus on accumulating kind of inflation hedges over the long term?
I don't think deflation will be allowed for any period of time in any sustained period of time. With that said, it's really important, I think, for people to understand that what we're going through is something nobody alive has ever seen. First bursting global sovereign debt bubble in 100 years, one in which it's a debt-backed, sovereign debt-backed system, one where you have these hyper deflationary technologies coming into place with AI and humanoid robotics, also putting pressure on the system, peak cheap commodities. There's a lot, a new geopolitical Cold War, if you will. There's a lot of crosswinds, and so I think over the course of the cycle, I think everything is pointing to higher rates of inflation on a sustained basis. With that said, example I use all the time is in one of the greatest hyperinflations of all time in Weimar Germany. If you borrowed Reichsmarks and bought gold, you lost all your money 4 different times because the counter moves are so sharp and they're so political. You can't. It's not basically what I'm saying is and the way I'm positioned is unlevered, and expecting a sustained cycle of higher rates of inflation.
Also higher costs, I would say stagflation, shrinkflation, or as Keynes would say, cost push, because if they're going to start moving a lot of factories out of China, say to Mexico or India, I mean, that's going to cause a lot higher costs.
Yeah, that's going to cause higher costs. War's inflationary, supply chain. It's and this is partly why I go back to what I said before about they missed their window in 21-22. They needed to get the GDP back to 70-80% before they started tightening to have had real operating room, and they didn't. And so they don't really have operating room.
Well, that's DC's fault because all DC wants to do, both political parties, Republicans and Democrats, they want to come to DC and they want to spend more. So none of them, like maybe occasionally on Fox News or Fox Business, you'll hear a Republican go on there and talk about cutting spending, but they don't actually cut spending significantly, neither party.
No, it's true. And, ultimately, that's the voters' fault. Everybody loves something for free. And then when the bill comes due, everybody's arms get real short, and where the bills due on a number of fronts.
Well,
and
I think
arms are really short.
In my opinion, the system is so wasteful and corrupt. I'm not sure voting at this point matters much. I mean, both political parties, the spending and the incentive system for politicians and bureaucrats here, federal ones here in DC, when they get here, I mean, the incentive system is broken. We need term limits, like full term limits, permanent term limits, excuse me, for people like the Senate and House of Representatives, no career politicians. And now you're seeing the brunt of it where it's gone to those corruption levels of Rome, like you said earlier.
Yeah, term limits might conceivably really help. And it's, like I said, if you started seeing things like that, it would be encouraging. But I don't think it doesn't seem like we're moving in that direction.
Well, you'd have to get Congress to approve term limits, right? Just like you have to get Congress to ban insider stock trading.
Yeah, no, it's and in the same way, it's like, well, we China, we want to compete with the Chinese. Well, okay, what are you doing about dollar outflows to China, and what are you doing about Chinese capital being recycled back into the U.S.? And the answer is nothing. And so as long, but to do that, you've got to be willing to basically change the structure of the dollar's reserve status. You've got to put capital controls up in the United States.
And I think most boomers who own a lot of assets, especially like S&P 500 stocks or index funds or some of the large cap tech companies, I think they're happy with the arrangements there because they're making a lot of money off this, the Cantillon effect and the asset price inflation, but it's creating like generational wealth disparity here between the haves and the have-nots.
Yeah, it is, and that's going to be that I think it'll be increasingly challenging. I mean, we'll see how it plays out from here, but it's there's a lot of ways that sort of traditional thoughts around demographics, et cetera, could really get turned on their heads. It's always thought that growing demographics is always a positive, and maybe that's not the case if you're in a system where technology's taking a lot of jobs, AI, humanoid robotics, et cetera.
Yeah, we'll have to see if artificial intelligence, if the hype lives up to it over the next, I don't know, 5 to 10 years with the investments and stuff. Because the copper price had this huge rally with China and India stockpiling, and then you had everyone talking about all these data centers. Well, these data centers, they sound amazing, but they're not. Most of them aren't even under construction yet. So that's coming in the next couple of years.
Yeah, we'll have to see.
Well, Luke, I really enjoyed our discussion today. I want to thank you so much for your time. If my listeners want to check out your paid newsletter, Forest for the Trees or Tree Rings, how do they do so?
They can check us out, fftt-llc.com for more information. And I'm on Twitter or X at Luke Gromen, Lukegromen.